Hello everyone, I hope you had a wonderful Thanksgiving. Jacob and I took a break last week for family time and just, kind of getting ready for the holidays. So it's time to get back in the saddle with Let's Talk Mortgage. Unfortunately, Jacob's feeling a little under the weather today, so he opted to go ahead and just bow out of this week's video. You will see him back though next week, I promise. So in the meantime, in the last video, we talked about retirement accounts and stock accounts and talked a little bit about 401ks, which of course most employers do participate in of big enough size. Jacob commonly hears me talk about 401ks and being able to take those money out of your 401k in an effort to buy a home. And so of course he was asking me in the car when we were coming back from our little mini vacation from Thanksgiving, could people use their 401k monies for buying a house? And of course I said, absolutely they can. If you don't have the money in your checking or savings account handy for closing, for the down payment, the closing cost, the taxes and the insurance, otherwise known as prepaids, you most certainly can use your money from your 401k for your home purchase. Of course, your 401k is supposed to be for retirement, for your savings, but sometimes things happen and you just don't have the money available. And maybe you don't qualify for any of the programs out there with low down payments or with assistance. And so therefore, of course, it's better for you to own a home rather than pay for somebody else's mortgage, right? When you're renting, that's what you're doing. So, if that's what it takes for you to be a homeowner and to have that little slice of the American dream, so to speak, then so be it. That's what you do. Rents are going up a lot right now to the tune of about 10%. So the sooner you become a homeowner, the faster you can establish equity in your own home rather than someone else's. So that being said, how can you get your money out of your 401k in order to buy a house? You can do two ways of taking the money out of your 401k. First things first, you can withdraw the money, completely withdraw the money, or you can borrow from yourself. I happen to be a fan of the latter because when you borrow from yourself, you pay yourself back. And the cool thing about that is when you pay yourself back, it's at a very low interest rate. Usually it's about 2 to 4% that you're paying yourself back at. Now, of course, if you're withdrawing the money or you're borrowing the money from yourself, it's still out of the market, which means that you can't grow your money like that. But at least when you're borrowing it from yourself, you're putting the money back in. And when you're withdrawing it, you're usually not going to redeposit it. I can tell you that in my 26 years of lending, I've had no one tell me, I put the money back in my 401k later. They just don't do that. But when you're borrowing it, you do. So the cool thing about the borrowing it, like I said, is that you're repaying the money back to yourself. You're putting it back into your investment account of your 401k. And then as the market goes up, you're actually buying again into those investments and you're going to make more money on those investments in the long run. So if you're going to withdraw the money from your 401k rather than borrowing it, there are certainly consequences of withdrawing it. On the borrowing side, it's just that you're taking yourself out of the market. That's all you're doing. On the withdrawal side, though, there are 3 consequences that I wanted to go over in this video, just to kind of share with you the 3 things you need to think about. Number 1, taxes will most likely be withheld. If they're not withheld from your check and the request of your 401k withdrawal that you're doing, they will affect you at tax time. So you want to definitely check with your CPA or your tax preparer to know and be prepared for those consequences. But what happens is the IRS generally requires a withholding of 20% on a 401k early withdrawal for taxes. So if you withdraw $10,000 from your 401k for your home, you will usually get about $8,000, okay? And that's assuming that like you're, in your 40s or 30s or 20s or whatever you're in. You're not of retirement age yet, which is considered to be 59 and a half, according to the IRS. I hope I can retire at 59 and a half. Really hope so. Anywho, so depending on your income, if you don't have the withholding taken from the withdrawal, meaning that they're not taking that automatic 20% penalty out for the taxes, not really a penalty, but I think it kind of is, of those taxes, you will, like I said, need to talk to your tax preparer to make sure that you know what's going to happen come tax time. What are the ramifications going to be? Are you going to have to write a check to the IRS later? I would just rather get it over with and take the withdrawal taxes right then and there. So just be careful. Make sure you know what your options are and what you're doing. The second thing that happens when you take that withdrawal is the IRS will penalize you. So this is a true penalty. This is not a tax. This is a true penalty If you take the money out of your 401k before the age of 59 and a half, the IRS will assess a 10% penalty when you file your tax return. This means that you're giving the government $1,000 of that $10,000 withdrawal. And by the way, most employers these days will actually take that penalty out of the check when they give it to you so that you don't have to worry about it come tax time. Check your forms though. When you actually go to make your withdrawal or your borrowing against your 401k, when you do buy a house, it's going to tell you what they're going to take out. And you have little boxes you can check yes or no. But again, check with your tax preparer and make sure you know how it's going to be handled on your tax return. So assuming you have the 20% automatic tax, assuming you have the 10% penalty, that $10,000 withdrawal becomes a $7,000 deposit to you. So just keep a watchful eye on that. And then of course, the third thing and third consequence of you withdrawing from your 401k, it means that you have less money in the future in your 401k retirement account. This may be especially true if the market's down. Today is November 30th, Tuesday, November 30th, and the Dow lost 652 points today. That was a really bad market day. So if today you were taking the money out of your 401k, you're taking it out on a down day. You want to buy low and sell high when it comes to stocks and anything else that you're invested in. So that would just be one of those things that you were going to be selling on a downside, and then you're going to have to recover longer on the investments that's left in your 401k. So the good news is that you have a 401k to take your money from. And so again, in my professional opinion, I do recommend that you borrow against your 401k rather than just taking it out, because you're going to pay yourself back and you're going to avoid those penalties and taxes. So I hope that this video serves you well. I would love to help you with your home purchase. And every Tuesday we do Let's Talk Mortgage. So please do share, like, and comment. And I really hope that you had a wonderful Thanksgiving with your family. And we look forward to bringing you wonderful content in the future. Have a great one.